Welcome back to the Mentored Show, which offers quick lessons packaged within minisodes for busy founders and startup leaders like you. I am Adel, and I'm being mentored live and unscripted by Ed, who's built, sold, turned around, and scaled startups all the way to the New York Stock Exchange. He's based in the US, a developed economy, and I'm based in Dubai, a hub within an emerging economy, and we compare notes. This is real talk, no scripts, no theory. Let's get into it.
I believe it impacts everyone. Understanding, especially for founders, understanding who to fundraise from, because these VCs are becoming more involved and building the product, consolidating companies. They're no longer just making calculated bets and being quiet. They actually are more involved, and they take a responsibility for making sure that the startup is successful. Now, for me as a founder, also, it might work the other way around. I don't want anyone to interfere in my company. I don't want them to get too involved, dictating what I do, and then suddenly they force me into merging with someone else. I don't want that. So the first question is, how fast do you see this trend from VCs becoming operators and following startup studio or a venture studio model or a hybrid model? And how should the startups or the founders and their leaders think about it? Whether it's positive or negative, how should they deal with it?
I always want to give a short and concise answer to these questions. And where I am personally challenged is that the question really has a lot of context to it. And without knowing some of the context, it's hard to fully appreciate the answer. With that, I've always suggested strongly to an entrepreneur, learn the personality of the money source. Money has a personality. If you pick an investor who is always in your business, you might not like that. You might enjoy taking their check and cashing it and investing in your company, but you might not like the intrusiveness of that investor. On the flip side, you might take money from an investor who is very hands-off, and you enjoy cashing the check and putting the money to work. But when you really need advice and you're in a confused state of mind, there is no advice to be had because the investor is never participating. Those are two extremes, right? And I think that if you pick money that has a degree of involvement, participates at those key moments when you need the advice, and is very supportive to your mission, that's the best of all worlds. I think what's happening today is that venture capital and private equity are coming closer and closer together. And it's not like this idea has not been tried in the past, but the markets of the past are very different from the markets today. The markets today are absolutely focused on quality companies. Investors today, public investors, private investors, institutional investors, are looking for companies that can tell a story about growth and profitability in a period of time that is less forgiving than it was in the past. And all you've got to do to appreciate what I've just said is look at all of the stupid companies that got funded during the internet bubble of 2000. Literally, all you had to do is have an idea, ask for money, and the money came. And if you think back to the year 2000, when the internet bubble blew up, companies were going bankrupt left and right. Private companies, public companies, the quality was incredibly low. If you fast forward 25 years from year 2000 to 2025, all you hear about now are what is the quality of the company? What is the quality of the founders? What is the quality of the ideas? What's the quality of the investment syndicate behind the company? Because without that quality, without that path to profitability, without the growth, an IPO becomes very difficult to do. And I would suggest that, again, if you look today at, quote, hot companies in the stock market, there's going to be growth companies where the analyst community will constantly be looking for the company to grow at 30% or greater year on year, right? Big opportunity. They want to see that company acquire as much market share as possible. less focused on profitability, but not zero, right? They want to see the profitability number improving. So if you're negative on your profits year on year, they want to see that negative number become smaller and smaller because you're moving towards break even. And then ultimately, your second phase is your growth will slow, but your profitability will increase. So maybe instead of a 30-40% growth number, you're looking at a 10-20% growth number, but you're looking at a 20-30% margin in the tech business, right? And that's how that scale maintains equilibrium between growth companies and profitable companies. And the VCs and private equity firms that fund these businesses are looking for quality of growth, quality of earnings, quality of team, quality of product, all about quality.
You mentioned the syndicate, the quality of the syndicate and the diversity of the syndicate. This is something that many founders, and because sometimes you don't have the choice, right? You're depending on what money is available. This is at least the case for most startups, most founders, and especially if it's outside of Silicon Valley, let's say in emerging markets. The abundance of cash is limited. We can't be picky. So how does the diversity in the syndicate, first, what is it? And then what's the optimal case and how does that impact the company as it grows?
Well, I think as a founder, you have to be brutally honest with yourself about how much cash you need. I believe, I'm just going to cut to my prejudiced point of view, which is the real answer is you don't know. So whenever I talk to a founder and the founder says, all I need is $1 million, I know that answer is wrong. You don't know. You don't know how long it's going to take to build a product. You don't know if version 1 of the product is even the right product for the market. You might end up flushing $1 million down the toilet and have to start all over again. So I would say to an entrepreneur, build out your business model, describe your product, describe the problem that it solves, describe how you think you're going to sell that product to the market. And all of these questions that you ask are going to build out a spending plan. How many people do you need to hire? How much infrastructure do you need to acquire? Et cetera, et cetera. And whatever your projections are, it's going to take twice as long and cost twice as much. So when you start looking for money, look for money that has the commitment to support you through the hard times, not just the good times. And if you're trying to raise money and you've been taking a lot of no's for a long time, you're getting frustrated, you're starting to doubt yourself, yes, you will get desperate. And you'll take money from any source because you want to keep your dream alive. Just know that when you make that decision, the other commitment you're making, whether you realize it or not, is if you're willing to take money from any source, including a source that may not be there for the long term, you need to be very execution oriented day one. Find a way to grow your revenue, find a way to get to profitability quickly. Because if growth is not there and profitability is not there, the likelihood of raising money from an emotional investor is very low. Because investors today are looking for quality of growth, quality of earnings.
That's it for this minisode. Big thanks to Ed and to all of you for tuning in. If this sparked something, hit subscribe so you don't miss the next one, and make sure you share it within your network. Got a question for Ed? Drop it within the comments. See you next time.
Please note, the views and opinions expressed in this podcast are those of the host and guests and do not necessarily reflect the official policy or position of any affiliated organization. The content provided is for informational purposes only and should not be considered as professional advice. We encourage listeners to conduct their own research and consult with relevant professionals before making any business or career decisions.